Margaret retired at 68, 34 years as a school principal in Ohio. She had $680,000 in a traditional IRA, a small teacher's pension, and about $34,000 a year in Social Security. Her longtime accountant, a guy she'd used for 2 decades, told her she didn't need to take her first required minimum distribution until April 1st of the year after she turned 73. You get that extra grace period, he said, use it. So she did. Then the Medicare premium notice arrived the following November. Margaret was now paying an extra $4,130 a year in IRMAA surcharges. 85% of her Social Security became taxable. Her federal bracket jumped. That one decision in delaying one RMD by 4 months cost her $9,347 in a single calendar year. And the thing that would have prevented it was taking her first RMD by December 31st of the year she turned 73. A free move, sitting right there. Nobody told her. Margaret is not unusual. She is what happens when a retiree with a lifetime of careful saving trusts a generalist accountant to handle specialized retirement rules. If you are turning 73 this year, you are sitting on the same ledge she was. Not the retirees who are 65. Not the ones who are 80 and already past this. You, specifically you. The federal government will take $9,000, $15,000, even $30,000 out of your savings over the next 2 years, if you miss the deadline I'm about to explain. Today, I'm going to walk you through the exact 6-step playbook to avoid it, every one of them before December 31st. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Frank Dalton. I spent 35 years as a CPA working with retirees before I stepped back from the practice. Every week on this channel, I break down the tax rules, the IRS traps, and the strategies that protect retirees from the things your advisor never mentioned. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me get into it. Number 6, the December 31st versus April 1st. Trap. Let me start with a single decision that will cost you more than everything else combined. Here's the rule. You turned 73 this year. The IRS says you must take your first required minimum distribution by April 1st of the year after you turn 73. So technically, you have until April 1st, 2027 to pull out your 2026 RMD. Sounds generous. It's not. It's a trap. If you wait until 2027 to take your 2026 RMD, you still have to take your 2027 RMD by December 31, 2027. That means 2 full years of distributions hit the same tax return. 2 RMDs, 1 year. All taxable as ordinary income. Let me put a dollar amount on this. Richard, 73, Virginia. His IRA balance on December 31st of last year was $920,000. His 2026 RMD is $34,717. His 2027 RMD will run roughly $36,000. If he stacks them, he reports about $7,700 in RMD income on his 2027 return on top of his pension and Social Security. That pushes him from the 22% federal bracket into the 24% bracket on a big chunk of that money. It pushes his Medicare premium into IRMAA Tier 2. It makes 85% of his Social Security taxable instead of a lower percentage. Here's what most retirees don't know. The April 1st extension is only available for the first RMD. Everyone after that is December 31, so the grace period just guarantees you'll stack 2 RMDs in a single year exactly once. That's the trap. It's not a gift. It's a landmine. And then there's the biggest one. Number 5, the 25% penalty. The IRS wrote this number specifically to make sure you pay attention. Miss your required minimum distribution deadline and the IRS charges you a penalty equal to 25% of the amount you were supposed to take out. Not 25% of the tax owed, 25% of the entire distribution. Let me put a dollar amount on this. Robert, 73, Michigan. His 2026 RMD is $40,000, he forgets. April 1, 2027 comes and goes. The penalty is $10,000, flat. That's before the regular income tax he still owes on the money when he finally pulls it. Now here's the mercy clause. If you catch the mistake and fix it inside the correction window, pull out the missed amount and file Form 5329, the penalty drops from 25% to 10%. Still $4,000 on Robert's miss, but not $10,000. And if you can show reasonable cause, serious illness, a natural disaster, documented bad advice from a tax professional in writing, the IRS can waive the penalty entirely. But you have to ask. You have to file. You have to document. The IRS does not waive penalties because you didn't know. Here's what most retirees don't know. Before 2023, this penalty was 50%. The Secure 2.0 Act cut it to 25. The media barely covered the change, so there are still CPAs quoting the old number, and there are still retirees writing checks they don't need to write. Here's the part that should bother you. Number 4, the aggregation trap. This is the rule that trips up everyone with more than one retirement account. Traditional IRAs aggregate. If you have 3 IRAs, you calculate the RMD on each separately, then pull the total from any single account. 3 IRAs, one combined number. Take it all from the smallest one if you want. Fine. 401ks do not aggregate. If you have an old 401k from one employer and another 401k from a second employer, each one has its own separate RMD, and each one must come out of that specific account. You cannot pull both from one. You cannot pull a 401k RMD from your IRA. They are walled off silos. Let me put a dollar amount on this. Patricia, 73, Florida. She has a $600,000 IRA, a $300,000 old 401k from her hospital years, and a $150,000 401k from consulting. She added all 3 balances together, divided by 26.5, got roughly $3,900, and pulled it all from the IRA. She thought she was done. She wasn't. The $300,000 and $150,000 401ks each needed their own separate RMD, about $11,300 and $5,700. She missed $17,000 in 401k. Distributions entirely. The 25% penalty on that is $40,250, all because she didn't know IRAs and 401ks follow different rules. Here's what almost nobody catches. If you roll every old 401k into a single IRA before the year you turn 73, the whole aggregation problem disappears. One account, one RMD, one deadline. Most retirees should do this rollover in their late 60s. Almost none do. This next one is the one most people miss entirely. Number 3, the IRMAA cliff. IRMAA stands for Income-Related Monthly Adjustment Amount. It's the surcharge Medicare stacks onto your Part B and Part D premiums when your income crosses specific thresholds. In 2026, if you're married filing jointly and your modified adjusted gross income is projected to exceed roughly $212,000, you hit the first IRMAA tier. Cross the second threshold, Tier 2. Each tier stacks higher premiums. Here's the cruel part. IRMAA is a cliff, not a slope. $1 over the threshold, and you pay the full surcharge for the entire year. Not prorated, not adjusted, $1. Let me put a dollar amount on this. Thomas and Linda, both 73, Texas. Their income without the RMD is $205,000. Their combined RMD this year is $48,000. That shoves them to $253,000 right into IRMAA Tier 1. Their extra Part B and Part D premiums for both spouses total roughly $430 for the year. If they'd managed the RMD, split it across tax years, used a QCD, or converted some of the IRA to Roth before $73, they would have stayed under the threshold entirely. Here's what most retirees don't know. IRMAA looks back 2 years. Your 2028 Medicare premium is based on your 2026 tax return. So the RMD you take this year sets what you pay for Medicare in 2028. You can't undo it in real time. You have to plan ahead. And there's one more piece that makes this worse. Number 2, the Social Security tax torpedo. Your Social Security benefits are only partly taxable, but up to 85% becomes taxable once your provisional income crosses certain thresholds. Provisional income is your adjusted gross income, plus non-taxable interest, plus half your Social Security. Married filing jointly, cross $32,000, up to 50% of your Social Security is taxable. Cross $44,000, up to 85%. These thresholds have not been adjusted for inflation since 1983. Say it again, 43 years. No inflation adjustment. The $32,000 cutoff in 1983 would be roughly $103,000 in today's dollars if it had kept pace. It hasn't. So the middle class tax on Social Security has quietly turned into a basically everyone tax. Let me put a dollar amount on this. Susan, 73, widowed, Pennsylvania. She gets $38,000 a year in Social Security. Before her RMD kicks in, her other income is $28,000 from a small pension. Her provisional income is already $47,000, meaning 85% of her Social Security is already taxable. That's $3,200 rolled into her taxable income. Now add her $22,000 RMD on top. Her federal tax bill jumps roughly $4,140 on the RMD itself, plus additional tax on the portion of Social Security that is now fully exposed because the RMD raised her AGI. Here's what most retirees don't know. Money pulled from a Roth IRA does not count toward provisional income. It doesn't push Social Security into taxation. It doesn't trigger IRMAA. Every dollar you converted to Roth before 73 stays invisible to these formulas forever. And then there is the biggest one. Number 1, the QCD escape hatch. This is the one your CPA probably hasn't mentioned. The Qualified Charitable Distribution. If you're 70 and a half or older, you can transfer money directly from your IRA to a qualified charity. The transfer counts toward your RMD. It does not count as taxable income. It does not hit your AGI. It does not push you into IRMAA. It does not expose your Social Security. It is invisible to every tax formula that matters. Let me put a dollar amount on this. James, 73, North Carolina. He gives $8,000 a year to his church and $4,000 a year to a veterans charity. His RMD this year is $28,000. If he takes the whole RMD as income and then writes checks to the charities, he can't deduct the donations because he takes the standard deduction, which roughly 9 out of 10 retirees do. So he pays tax on the full $28,000, then donates $12,000 of after-tax money. His federal tax at the 22% bracket is $6,160. Now instead, he makes $12,000 in qualified charitable distributions directly from his IRA custodian to those charities. His taxable RMD drops to $16,000. His federal tax drops to $3,520. He saved $2,640, and the charities receive the identical amount. And his AGI is $12,000 lower, which may drop him under IRMAA and Social Security thresholds, saving him even more. Here's what most retirees don't know. The QCD must go directly from the IRA custodian to the charity. If you take the distribution first and then write a personal check, it doesn't qualify. The mechanics matter. Your IRA custodian has a specific form. Call them, don't improvise. Let me give you a real example of how this plays out. Take David and Nancy. David is 73, Nancy is 71. Georgia. David has $1.2 million in a rollover IRA. Nancy has $400,000 in her own IRA. David gets $38,000 in Social Security. Nancy gets $24,000. They have a small rental property paying $14,000 a year. Household income before David's RMD, $76,000. In the do-nothing scenario, David takes his entire $45,083 RMD as ordinary income on December 30th. Household income jumps to roughly $121,000. 85% of their Social Security is now taxable. Federal tax bill, about $14,200. In the planned scenario, David makes a $10,000 QCD to their church and a $5,000 QCD to a local food bank. His taxable RMD drops to $30,283. The $15,000 of charitable giving is completely invisible to the tax formulas. Federal tax bill, about $10,800. That is $3,400 back in their pocket. This year, over 12 years of RMDs, assuming flat numbers, that is over $40,000 on the exact same income, just a different routing decision. Now compare that to the grace period scenario. David delays his first RMD to March of 2027. He takes the 2026 RMD and the 2027 RMD in the same year. Their combined AGI crosses RMA Tier 1. Medicare premiums jump $4,130. The higher bracket adds another $2,100 in federal tax. Additional Social Security exposure adds $3,070 more. Total cost of the delay, roughly $90,300 in a single year. That does not mean delaying is always wrong. If you have a one-time income gap, a year of low earnings before Social Security starts, for example, delaying the first RMD into a low-income year can save money. But if you are delaying purely because your accountant told you you can't, you need to see the full picture before you wait. Let me bring it all together. Here are all 6 in order. 1, the April 1st trap. Taking your first RMD in the grace period means 2 RMDs stack in the same tax year. Take it by December 31 instead. 2, the 25% penalty. Miss the deadline, the IRS takes a quarter of what you should have pulled out. Fix it within the correction window, it drops to 10%. 3, the aggregation rules. IRAs combine, 401ks don't. Consolidate old 401ks into one IRA before 73, so you have 1 deadline, not 4. 4, the IRMAA cliff. $1 over the threshold, you pay the full surcharge for 2 years. Your 2026 tax return sets your 2028 Medicare premium. 5, the Social Security torpedo. Once provisional income crosses $44,000 for couples, 85% of your benefits are taxable. Every RMD dollar compounds it. 6, the Qualified Charitable Distribution. Directly from IRA to charity counts toward your RMD, never hits your AGI. 6 things the IRS expects you to know. All of them matter. Most retirees know 0 of them on the day they turn 73, and every single one you miss costs you money. This is Frank Dalton. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it before December 31. If you're not subscribed yet, Hit subscribe and turn on the bell so you don't miss the next one. The video I'm working on next breaks down the 3 Roth conversion moves retirees should make before year end. True in the single mistake that cost the average couple over $23,000 last year. You need to see it before the December 31st deadline, because after that, your options collapse for the 2026 tax year. And if you know someone who turned 73 this year, a parent, a neighbor, a friend, send them this video today, not tomorrow, today. The IRS deadline is fixed. Every day they wait is one less day to act. Drop a comment below. Tell me, did your advisor or accountant explain the April 1st trap to you before you turned 73? I read every single comment, and the most common situations become future videos. I'll see you in the next one.